Welcome to the Stockout. This is your show at FreightWaves for the CPG and retail industries. I am one of your hosts, Mike Baudendistel, joined by Grace Sharkey. And Grace, I was just looking at your article entitled 20 Company Reactions, Good and Bad, to Trump's Tariff War. And I'm interested to know, whose reactions were good, because the only one that I saw, that I remember seeing was like a clothing reseller thought it was great. I'm like, this is great for the environment. Of course, it's just sort of great for their business. But who has reacted favorably?
Well, I had to, make sure I put a couple of both sides of the argument or equation in this article, and there were a couple I think in particular that maybe one will get a little creative with as well. But number one would probably be Whirlpool. So Whirlpool, actually, about 80% of their products are made to produced domestically. So they looked at themselves as a winner against at least their more foreign competitors, right? So I think that of all of them is probably the most positive one. Again, these are from statements, oftentimes from earnings as well. So we could be looking at a little positive marketing spin, but I think just with their competitive advantage and how they are producing their products, Whirlpool would likely see this as an opportunity to jump ahead and win. A little bit of maybe some Zoom action in the good old Skype era, you could say, back in the day, right? This is a chance for them to be strategic and jump ahead of their competition. Another one I viewed, and I believe he was at the White House last week as well, just because of the opportunity for investment in the United States in particular, was Nvidia, who did announce, right, the $500 billion they're looking to start building out AI infrastructure and production for chips as well in the United States. I look at that as a positive one, especially because regardless, I think, of if we wiped away the tariff discussions we've had over the last couple of weeks, there was always that concern of how Taiwan fits in the equation when it comes to semiconductor chip production
Mhm.
as well. So I personally view this as a positive for the company, but also for Americans as well, because again, I think this is something that would have have been seen down the line, dependent on more of the China Taiwan talks. But I think overall, especially for if we start seeing more and more electronics production in the United States, or even more so, just in this side of the globe, we'll likely want that production here as well. So those are my two winners. But again, it is an article of 20, so there's a couple in there, maybe 18 or so, that weren't so positive. That we can see how they play out over the next year or two.
You mentioned a lot of companies in the CPG and retail industries, and rather than going through them all, I think there's a few themes. And one of the themes is a lot of the CPG companies either just more cautious on the outlook for the consumer, not so much because they think their costs are pressured directly, but it's more that they think there's going to be inflation in the economy, and then customers are going to cut back on their items, kind of like Procter and Gamble. You think of those as being sort of necessary products, but there are cheaper alternatives to most of them. So I thought that was kind of an interesting theme there.
Yeah, I mean, let's be honest again. If we were to wipe away the tariff talks, we on this show we've constantly discussed going into 2025, a year where the consumer just isn't likely to spend more than we hope to see. So I think that is part of why you're hearing those reactions from them, because there's already this concern of where is the consumer going to fit us into their budgets on a monthly basis. And now you add on the fact that a number of these companies likely will end up passing this on in some way, and inflation discussions as well. That puts them into an even deeper consumer situation too. So again, I think that's what makes this time period so interesting, or at least the tariff talk so interesting, is because on the other side of this, you have consumers who are maxing out their credit cards, become delinquent more than they have in the past, not to talk about even mortgage delinquency numbers that we're starting to see as well. So, as much as we want to talk about what will happen with the tariffs over time, And hopefully, if in Trump's world that this does help somehow lower prices, we still are in an economy where the consumer is struggling to get by, the average consumer, day to day. And I think that's important to know in the discussion of all these as well.
Yeah, and another theme from your article, I think, was some of the companies in the retail and CPG industry actually absorbing some of the higher costs from their suppliers, and not passing on those price increases right away, which is a little bit surprising, and certainly is sort of a departure from what we've seen the past several years, when those companies were very happy to increase prices. And then you had an interesting line from Walmart instructing some Chinese suppliers to resume shipments that had stopped shipments temporarily, sort of signaling a potential de-escalation. You would think Walmart really is plugged in, probably better than most companies. Walmart's committed to absorbing the added tariff costs, easing the financial burden on its suppliers. So it is a situation. When you think of Walmart as being just sort of this really tough customer for its suppliers, showing maybe some ability to work with those suppliers, as well, and sort of the time of uncertainty. So it's they may be tough but fair. So I thought that was a really interesting comment. And I want to move on to this next story. You probably saw de minimis exemption has ended for Chinese produced goods. That was as of May 2nd. The Chinese origin shipments under $800 that had been tariff-free under that de minimis exemption, which was a higher threshold than you see in most other countries, is going away. And so what that means is for parcel, the tariff is 145% baseline tariff plus product-specific tariffs, which could take it up to some cases 377%. On the postal side, 120% of the baseline tariff, or a $100 flat fee, and that flat fee is going to rise to $200 on June 1st. Administration plans to end the de minimis for all other countries once, quote, adequate systems are in place. We'll see how long that is. But this is already having big implications. You directed my attention to this tweet or X from Aaron Rubin. We're going to have Aaron on the show next week. So this is a preview of coming attractions here. But he says, go to Temu right now, removed all direct China shipped items. Temu is only selling items that are in U.S. warehouses, ending 3/21 has changed everything. So these companies are under a lot of turmoil, really changing their processes there. Also seeing the reports that Shein, which is planning to potentially have an IPO in the London markets, because I guess the U.S. Exchanges didn't want them. It sounds like that's going to be delayed. So what do you think ultimately happens with Shein and Temu because of all this?
Well, it is interesting because I think we talked about this show like in September. I had made this big Temu purchase, and the interesting fact that I noticed from that experience is that there was a good amount of those shipments, because they'll show you kind of like right where they pick up and where they're warehoused at. I would say 90% of them actually came from a warehouse in the United States. One or two items had to come from China. So I agree with you in the fact that I think Temu, and I'm sure Shein as well, especially we know that the Shopify investments that they've made there too, partnering with them. I think that this has always kind of been a concern for them. Maybe how quickly it's happened and how strong the tariffs have been to push the situation. It was probably not seen, but in general, I think at least Timu, I'd say Shein as well, with the partnerships they've made, have been waiting for this type of tension to come when it comes to both of their sites and their, I don't want to say
Mhm.
products as much as their selling capabilities as well. I am interested in how they fare. Of course, we'll have Aaron Rubin on the show next week to see how he thinks of it from more of this like e-commerce perspective. But um, I am interested in how they compete now with that domestic aspect here. With, of course, Amazon nowhere near as big, but again, if they can somehow avoid kind of lifting some of their products price points, I think that would help to change. I also kind of think the insane consumerism around these two sites has diminished a little bit. again, I'm not on TikTok on a daily basis, but it just seems to me like these two sites in general, and the people I know who have bought from them, they're not buying as many big orders. And I don't know if they have statistics out on that, but it's a few things here and there in between. So again, I think that the consumer was probably already hurting these companies. This is probably not helping, but it is a positive sign to see that they're already figuring out their way, maybe not around this, but to work in this new normal of global shipping.
Yeah, one thing that seems to have gone back towards a new normal that's related to this is the air freight market. I have a sonar chart on this air freight market, which I think is interesting from Shanghai to LAX. These is air cargo rates priced in US dollars per kilogram. And you see where it was pre pandemic and then where it's been post pandemic. And it seems like now we're back to like the pre pandemic it's sort of
Yeah.
normalized where, the all the disruption with the air travel combined with the e-commerce stuff propped up air cargo rates, and maybe that's not true anymore. So that's been an interesting market to follow. Eric Kulish has written a lot of good articles on FreightWaves.com that go into a lot of detail there. So I would encourage you to check those out and check out Stuart Churl's articles on the ocean market, which are also very good. And I'm just going to have one quick sonar chart that sort of stands out, which is this ocean booking volume index in teal. And this is down 61% year over year. And it's based on a 14-day moving average. So it's really almost worse than it appears. Port of LA is now projecting imports to drop approximately 35% within the next couple of weeks, per one of the articles that Stuart wrote up. So it's going to have big implications for the domestic freight markets. So I'll leave you with that. Grace, you want to intro today's guest?
Yeah, of course. So, with us today is from DOS APR, Wiley Jones, the co founder and CEO as well. Wiley, thank you so much for joining us. I'd love if you could introduce the company to our audience and tell us a little bit about your background in the industry as well.
Awesome. Thanks for having me on, guys. Yeah, so we started the company about 3 years ago, working with a pretty wide range of businesses. I would say, our bread and butter is really working with any company that has physical operations components. So they're moving widgets, making widgets globally in the US. We work on software that helps companies with those operations. So some people want to call it ERP. You could put whatever acronym you want in front of it. At the end of the day, we're helping companies figure out what they have, what they're making, what they're producing, what they're selling to their customers.
Yeah, as one question is, it's just how is it different than a traditional ERP?
Yeah. So I think the very base explanation of it's got two parts. The first part is that I would say we really focus on helping design a solution around what our customers' actual business is, as opposed to forcing them to design their business around what the greatest common denominator of our software is. And I think that's kind of like the first part. The second, thing that drives as a question is, well, that sounds like customized enterprise software, which is, not a particularly new idea. The major distinction and where we find another layer of differences is that we're able to deliver a really bespoke composable solution in a very, very quick, window of time. And so that systems integration, system implementation, we're talking about bringing it down by, some anywhere between like 4 to 10x in terms of the amount of speed and the amount of time it takes, and the amount of man hours. And a lot of this fundamentally comes down to the way that we're using AI to go in and configure the product, and actually just the systems architecture from the ground up.
Yeah, it's interesting just kind of hearing you talk about this, especially a quick integration time, quick uptime, servicing the needs of clients directly. Perfect timing, I think, for issues that I'm sure a number of your clients are dealing with right at this moment in time. I'd love to hear from your perspective, especially being a little bit more part of the technology that runs these companies. What are you hearing that are major issues for them, and how does that um, flow into their operational challenges as well?
Yeah, the word flow is, I think, the right thing to anchor the conversation around. And where we see a lot of this come from, I think, is it really starts at the point of sale. It starts where business flows into, or commerce flows into their business. The challenges we see always come in the form of when companies move from doing one of something to multiple of something, beginning at the point of sale. You have multiple sales channels. You're going and selling into retail, into wholesale, direct to your end consumer over a Shopify website, let's say. You have all these different sales channels. You're trying to consolidate them down. You're trying to bring that together into a consolidated understanding of your inventory across different locations that you might have, first party warehouses, 3PLs, and then back down into finally the means of production. If you're managing your own factories, you're working with suppliers, you're going and working directly with tier 2s, tier 3 suppliers. The point at which you have to then tie those systems together and flow it backwards from understanding what your demand is today, your stock is tomorrow, your production needs are for the future. That entire life cycle is really difficult to manage for a lot of companies that are A, getting off the ground, or B, trying to respond to the changing landscape that's underneath them. As you guys were talking about earlier on the show, all the tariffs. The only answer to today's, I would say, broad, geopolitical, economic problems that we're seeing and changing landscape is you have to just move faster. And so when you have many of these systems, you're constantly going and turning over rocks every single day to try and make your business run. That's where we really help teams focus and leveling up.
Interesting.
Yeah, so you mentioned you're targeting companies that are moving sort of physical items around in their sort of supply chain, maybe companies that are a little bit early stage. Any other sort of commonalities in the markets that you're targeting, and who specifically in CPG has utilized your services?
Yeah, I would say on the CPG side, maybe it's a less accurate way of saying it, but when our customers are selling directly to their end customers in some way, it usually takes the form of like food and beverage, some type of home good like widget, apparel, kind of being somewhat adjacent, and beauty, cosmetics. A lot of times it's businesses that take the form of what we call a brand as opposed to maybe more so a company. And these brands really are just trying to find ways to get their product in front of more people, understand the costs and the inputs to those, those individual sales, and then making the operation from, point of production to the point of sale more efficient. Because at the end of the day, a lot of the people who are the management teams at these companies, they're really focused on the product, the experience their customers have with it, how they market it. It's less about the efficiency in the middle that ultimately determines the success of their brand, especially as they're growing. Once you get to the scale, I think you mentioned Procter and Gamble earlier on the show. Once you get to the scale of those companies, you have a whole different category of problems. The businesses that we focus on working with today, they're really about how do we get in front of an incremental buyer and get them an incrementally better product. The efficiency in the middle there's something that, they want to work with a vendor like us to help them figure out.
Mm-hmm.
Yeah, you touched on the multiple different channels for selling as well, which is something that we cover often on the show, and how those channels are maybe growing. And when you look at something like TikTok Shop or different social media sites in particular, what have you found that maybe your customers are using more than channel-wise than they have in the past, or maybe other avenues that you see less of as well?
Yeah, I think the most interesting one is just, and it's been obviously a common trend. This is not particularly a novel insight, but the strength of it has been most interesting was that just the sheer amount of businesses that use the wedge through e-commerce in order to do the brand building, but then a large amount of their volume comes through traditional retail, and they really deeply push into that as they're growing and expanding, past the tens of millions of dollars in top line revenue. I think it's really hard to understate how massive that movement has been. And also at the same time, how bringing on additional individual wholesale channels, retail channels, it's almost like each one has to be treated like its own unique channel as opposed to a subset of retail or subset of wholesale, because each of these like large trading partners can have completely different operational workflows. And so the challenge there is that there's a massive amount of dollars on the other side of it for the brand, but there's a large operational overhead.
Makes sense.
Yeah, that makes a lot of sense. I imagine this your system throws out a lot of data that your customers can use to sort of pour through, see where they're doing well, where they're not doing well, how better they can manage their inventory, where they're stocking out, those type of things. What type of sort of analytics software can be used to analyze that data?
Yeah, so I think there's, kind of the two layers of analytics that are interesting, which is the first part, which is just the basics of, do I know what I'm producing? Do I know what I have in inventory? Do I know what I'm selling? Which the bar for that is shockingly low. It turns out that just getting the correct answers on those things is actually quite hard, especially for brands that are quite fragmented in where they're producing things, where they're storing things, where they're selling things. So just getting the basic composite understanding of what is the true health of my business, what is the true health of our margins, contribution, gross margin, things like that, where we sell. The basic analytics there is actually less common than you would expect. The second layer of that is once you have all this information, it turns out it's actually pretty easy to automate the process by which that composite gets built so that you can put the entire system on autopilot. And many supply chain folks who are listening to this, or logistics folks who are listening to this, know the sprint to get reports like that built every week, every few months, or whatever it is, takes a lot of human effort. Putting that basic layer of analytics on autopilot and the automations there is actually a really powerful system to get in place, and that's something that we love facilitating. The last and final piece is you can sprinkle a little AI on at the end of the day, and it can do a lot of things that you couldn't do in the past related to forecasting and understanding things that are really hard for machine models to take in, like seasonality and promotions and stuff like that. So it's been cool to work with brands as we've been layering in more and more of those insights.
Yeah, it must be a really fun time for someone like yourself to bring your technology expertise into this discussion of just uh ever changing needs for these customers, right? And happy to see that you're attacking it as such as well. Now, of course, Wiley, if people are looking to reach out to you or learn more about the company, what's the best way for them to do so?
Usually the best spot is just head to our website, dos.com, DOSS.com. So yeah, just take a look around and send us a note. We're looking forward to hearing from folks.
Hey, I appreciate it, and thank you so much for joining us. Excited, hopefully, have you on the show later on to see how everything's working out too.
Thanks.
Of course, and for our audience, of course, I wanted to take a little bit of time near the end of the show to go over a number of fun events that we have coming up. I mean, it's May. We actually added a new event for July as well. So make sure that all of you after the show head to live.freightwaves.com to check out all of those. Coming up just, I want to say next week, in about 11 days now, we have our awesome Freight Fraud Symposium happening in Dallas, Texas. Of course, if you are a fan of Fraud Watch, my newsletter, then you know how important this event is. We've got some really great brands. Speaking of brands that Wiley was just talking of, really awesome brands, shippers in particular, who are going to be there and want to figure out what their logistics companies are doing to, of course, make their supply chains de-risk from as much fraud as possible at this point. So come join us in Dallas, Texas to learn from those who have some really great initiatives happening across a ton of companies, whether tech companies or logistics providers. And of course, hear how you can better de-risk your business from fraud as well. We also, of course, have our Domestic Supply Chain Summit coming up. That is a free event. You just have to, of course, register for it online. We're starting to do a number of those interviews now, and it's going to be a really great one. I mean, talk about tariffs. Domestic Supply Chain Summit is perfect timing for us to be diving into that. And then a new event that's coming at the end of July, actually, is our Supply Chain AI Symposium, doing a little bit more of these smaller events around the United States. And that's going to be in DC, which I think is going to be an interesting place to even have that AI discussion with the number of different ways we're seeing AI and technology being questioned and a governmental aspect too. And of course, we'll have some more updates on who to expect at that coming up as well. But head to live.freightwaves.com for that. But of course, Mike puts in a ton of work every week too, doing our Stockout newsletter, which comes out near the end of the week. Now head to freightwaves.com after this. At the top of the page, you'll see, of course, the newsletter spot and click that. Join the Stockout so you get updates throughout the week of what's happening to CPG and retail brands as well. And trust me, it's probably going to change tomorrow of what we talked about today, because that's just how the world works nowadays. And of course, join the Fraud Watch too. Might as well get some wonderful fraud advice from me every week too. And other than that, yeah, Mike touched on it. We'll have Aaron Rubin with us next week to go into a lot of views when it comes to tariffs from an e-commerce perspective, and how, of course, companies are dodging some tariffs, how they're getting creative as well. A little bit more of that discussion. But until then, hey, try to get some shopping in so we have some stuff to talk about, and make sure you join the Stockout newsletter as well.